What's going on? Alex here, and today we're going to talk about required minimum distributions and how they pertain to your 401k. So if you have a 401k, you're going to contribute to that account on a pre-tax basis while you're working at an employer or even if you have a solo 401k. So those are amounts that you're not going to pay taxes on in the years in which you contribute. Your taxes are going to be deferred to the point at which you start taking money out of the account. So as you're working, you're putting money in, and the question is, when do I have to take the money out? And when am I going to eventually pay taxes on it? That's a very good question. So with a 401k, generally the rule is in the year in which you hit age 70 and a half, don't ask me how Congress came up with 70 and a half, but it is what it is. In that year, that's your first RMD year, okay? So whichever year that is, you have a choice. Now, you can take your first RMD by December 31st of your beginning RMD year, or just for the first distribution, this is an exception, you can wait until April 1st of the next year to take that first distribution. So that's the basics of when you have to start taking money out of the account. You're going to be able to put in up to whatever the limit is and whatever match that your employer may put in on your behalf, that's all going to grow over time. Now, eventually it's going to get to the point where you're going to have to start taking required minimum distributions, and this is going to start to deplete the account over time. Now, when you turn age 70 and a half, like I said, you have until December 31st of that year to take your first distribution, or you can postpone it until April 1st of the next year. Not April 15th, April 1st. It's very easy to get those confused. The downside of waiting till the next year to take your first RMD is that in that next year, you're going to have to take one by April 1st and another one by December 31st of that year. So you're going to have to take 2 RMD distributions in a single year. Now, the effect of that is that you can bump yourself up to the higher marginal rates a lot quicker and overall end up paying a lot more in taxes. So the decision of whether or not to take your first RMD in that first year or to postpone until next year really has to do with what your income dynamics are going to look like and how much overall taxes you're going to pay in each situation. Now, 401ks are unique in that you can actually postpone distributions past that year in which you turned age 70 and a half. And the way you do that is by continuing to work. So if you continue to be an employee at whatever company you're with past that age, you don't have to take required minimum distributions for each year that you continue to work. The stipulation is that the IRS hasn't really defined what continuing to work really means. Now, do you have to stay full-time? Can you be part-time? Can you work for 3 hours a week? That's kind of a question that's still out there in terms of what the limit is to define what's still working and what's not. But generally, if you stay on even in a part-time role, you're safe. The distinction is, though, that you have to work for the entire year to be able to defer your RMD distribution. So if you work from January 1st to December 30th and then you quit, guess what? You're going to have to take a required minimum distribution, let's say if you're 72 or 73 years old, for that year, even though you worked for 364 days. If you stop working on that 365th day, you're still subject to the RMD for that year. So that's something to keep in mind. They haven't defined what it means to be still working, but if you're still working and you are not working the entire year, that's going to definitely create a problem for you. So that's something to definitely keep in mind about 401ks. And they're unique in that respect, in that you can actually defer the point at which you start taking distributions. Normally, with, let's say, an IRA, there's no flexibility to do that. Now, you might be asking the question, what if I own my own business and I have a solo 401k that I've been contributing to over time? Can I also defer the year in which I have to start taking required minimum distributions? And the answer is, unfortunately, probably not. Now, if you are a 5% or more owner of a business, then that ability to defer your first RMD year, unfortunately, does not apply to you. So if you have your own business for which you start a solo 401k, then in most cases you are not going to be able to defer that first RMD year unless you own less than 5% of it, which is typically not the case. So if you have the solo 401k, then certainly you need to be watching out in the year that you turn age 70 and a half for those RMD requirements, because they most likely will apply to you. So how do we calculate RMDs? How do we actually come out with the number that we need to distribute on an annual basis? That's a great question. Let's take a look. The way that we calculate the amount of the actual required minimum distribution that we need to take in a particular year is as follows. The first step is to pull up publication 590B right here on the IRS website. So with publication 590B open, we want to go to the appendices over here at page 43, and if you go down a little bit, you're going to find good old table 3. Now you'll see it says here for use by unmarried owners, married owners whose spouses aren't more than 10 years younger, and married owners whose spouses aren't the sole beneficiaries of their IRAs. There's a few different uses of these tables depending on what your circumstances are, but typically this is the one that we'll want to use on the most basic level, unless you have a spouse that's more than 10 years younger, in which case you want to go up and use table 2. But if this is your 401k and you are in a situation where you've been contributing to it over time and you want to make sure that you take out the right amount, this is the table that you want to start with right here. Now, when you look at this age column, this is the age that you are at the end of your first distribution year. So at the end of the year in which you turn age 70 and a half, at the end of that year, are you age 70? In which case, you're going to use 27.4 as your factor. Or are you going to be age 71, in which case you'd use 26.5. Now, let's look at this in terms of tax year 2018. So let's say you turned age 70 and a half within 2018. So now you have the flexibility of either waiting till April 1st, 2019 to take your distribution, which means you're going to need to take 2 in 2019, or you can take your first distribution by December 31st of 2018. So the amount of that distribution is going to be based on the value of your 401k account as of December 31st, 2017, and you have to divide that number by the factor that we get off this table. So if you're age 70 by December 31st, 2018, then 27.4 is the factor you're going to use. But if by December 31st, 2018, you're age 71, then you're going to divide the value of your 401ks as of December 31st, 2017 by 26.5. That's going to be your first RMD distribution amount. Now, whereas with IRAs, there's a way that you can aggregate distributions and so forth and get a little bit fancy there. Let's keep this simple and assume that for each of your 401k accounts, you're going to have to make this calculation, make sure you take that amount out of each respective 401k account to make sure that you're on the right track and you don't get subject to the penalties. The penalties for not taking required minimum distributions are not fun. They're 50% of the amount that you should have taken. So if you have an RMD distribution of $5,000 and you didn't take it, you're going to be subject to a penalty of $2,500. That's just at the federal level. The state is going to want a piece of that too. So if you have a $50,000 distribution, you can imagine paying $25,000 for not taking it isn't going to be fun because you're going to need to take it anyway. So you want to make sure you do it on time, and you want to make sure you take it in each respective year once you hit that magical age of 70 and a half. So if you have questions, feel free to drop them in the comments below. I hope this was helpful. Thanks for watching.